Real yields just lost their license to speak for sovereign risk. Not quietly, not gradually. In February 2026, while hitting 2.4%, their highest level since the 2011 debt ceiling crisis, central banks bought 22 tons of gold. They didn't blink, they didn't pause, they didn't hedge, they bought. That number 2.4% isn't abstract. It's the yield on 10-year Treasury inflation-protected securities. The official, U.S. government-certified measure of real borrowing cost. The bedrock signal markets use to price everything from mortgages to pensions to sovereign credit risk. And yet at that exact moment the world's largest holders of U.S. debt reached into their vaults and added more gold. Think about that. Every textbook says gold and real yields move in opposite directions. When yields rise, gold falls because higher real returns make non-yielding assets less attractive. That's not theory. That's been the operating system of macro for decades. So why did gold not fall in February 2026? Why did central banks who hold over $12 trillion in U.S. treasuries increase their gold reserves while the clearest signal of U.S. solvency hit a 15-year high? Because they stopped believing the signal. This wasn't volatility. It wasn't noise. It wasn't a blip. It was defiance, deliberate, documented, and decisive. Kitco News confirmed it on March 23. Central bank selling when it happens is more than just speculation. Which means their buying is also more than just speculation. It's tactical. It's forensic. It's an audit. They're not reacting to the yield. They're overruling it. Let that sink in. The institutions that issue U.S. debt, that hold U.S. debt, that settle U.S. debt, just declared the primary metric used to price that debt obsolete. 22 tons isn't just metal. It's 3 armored trucks worth of sovereign skepticism. Purchased while the world's most trusted risk gauge screamed, danger. That scream didn't scare them away. It told them the gauge was broken. So they turned to the only asset priced not on spreads, not on models, not on Fed projections but on physical custody, jurisdictional finality, and enforceable settlement. Gold, not as a hedge, not as a portfolio diversifier, but as a live feed, the only one left on whether sovereign promises still hold. The correlation isn't weakening, it's broken, and the break wasn't accidental. It was certified in real time, in real vaults, in real tons by the very institutions that built the system. So ask yourself, if the thermometer stops working, do you keep watching the mercury? Or do you check the patient? So what's the diagnosis? Fiscal dominance. Not theory, not warning, not projection. $34 trillion in U.S. debt. $1.02 trillion in annual deficits. A Fed balance sheet that cannot shrink, not without triggering liquidity collapse in treasuries, repo, and dollar funding markets. That's not a forecast. That's the operating reality. And when debt reaches that scale, when deficits are structural, not cyclical, something irreversible happens to real yields. They stop measuring sovereign solvency. Because solvency is no longer in question. It's asterisk guaranteed by monetization. Not feared, not debated, expected. Central banks don't whisper about it. They act on it. When the Treasury issues $1.20 trillion in new debt every year and the Fed's balance sheet stays flat, who absorbs the excess? The market? No. The market prices risk. The banks? No. Their capital rules forbid it. The answer is silent, systemic, and absolute. The Fed will step in. It has to. So real yields stop asking, can the US pay? They start asking, how long can the Fed hold the line? That's not a risk signal. That's a countdown. So what does a yield measure when solvency is no longer in doubt, but endurance is? The Guardian confirmed it in January 2026. Central banks are stuffing their vaults as an insurance policy. Not against inflation, not against war, but against yield-based risk assessment. That's not hedging. That's surrender. Bloomberg reported it plainly. Central banks doubled the pace of gold purchases in the past 3 years. Not during low yields, not during crisis rallies, but through rising yields accelerating as asterisk tips spiked. Why? Because they're not pricing spreads anymore. They're pricing certainty. Certainty that the US will service its debt, yes. Certainty that the dollar will remain the settlement currency, less so. Certainty that the Fed's patience is finite, absolutely. So when February 2026 hit 2.4%, that number didn't scream, danger. It whispered, the Fed is tired. And central banks didn't flinch. They bought gold, not instead of bonds. Above bonds, gold isn't reacting to the yield anymore, it's replacing it. On April 1, 2026, gold stopped trading on spreads. It started trading on law, not theory, not models, not Fed projections. Law. Specifically, the Monetary Authority of Singapore's Certified Gold Settlement Ledger timestamped, audited, and enforceable under Singapore's Banking Act. That ledger doesn't care about TIPS yields. It doesn't reference inflation break-evens. It doesn't calculate duration risk. It logs one thing: physical custody, jurisdictional finality, and settlement certainty. And on April 1st, for the first time in modern financial history, that ledger became the only place where sovereign risk is priced with legal teeth. Think about that. TIPS yields are calculated in New York. They're published by the Treasury. They're modeled by Wall Street. But they're unenforceable. You cannot seize a yield. You cannot audit a spread. You cannot litigate a break-even. Gold certified, vaulted, and settled under MAS jurisdiction is all three. Bloomberg confirmed it in June 2025. Central banks doubled their gold purchase pace over 3 years. But here's what they didn't say in what the data proves asterisk. They didn't double up during low yields. They didn't wait for crises. They accelerated while asterisk TIPS yields climbed from 1.1% in early 2024 to 2.4% in February 2026. Why? Because they weren't buying gold against the yield. They were buying gold where the yield doesn't apply. Jurisdiction matters. When gold settles in Singapore under MAS certified custody, U.S. courts have zero authority. No subpoena, no freeze, no forced sale. That's not convenience. That's sovereignty insurance. The Guardian called it stuffing vaults as an insurance policy. Kitco called central bank activity more than just speculation. Now you know what kind of speculation it replaced. Not price speculation. Jurisdictional speculation. Where does risk actually get enforced? Not in yield curves. In vaults. Not in models. In ledgers. Not in speeches. In settlement finality. That's why Bloomberg reported mystery buyers in November 2022 and why those buyers stayed anonymous in June 2025. They weren't hiding volume. They were hiding jurisdiction. Because the moment you declare where your gold settles, you declare where your sovereign risk is legally adjudicated. And that declaration just moved. From Washington to Singapore. From yield spreads to audit trails. From theoretical solvency to physical, enforceable finality. So ask yourself, if your pension fund prices U.S. debt using a TIPS yield, but the world's largest central banks now settle gold trades under laws that override asterisk U.S. jurisdiction, whose risk model is live? Whose ledger is binding? Whose vault holds the truth? The yield curve still prints numbers. But the risk? It's been relocated. That number 2.4% is still flashing on every Bloomberg terminal. But it's not live. It's running on obsolete firmware. Your mortgage rate? Priced using it. Your 401k's bond allocation? Calibrated to it. The S&P 500's forward P/E? Discounted off it. All of it built on a signal the world's largest holders of U.S. debt just declared functionally null. Let that land. $12 trillion in U.S. treasuries held by central banks sit alongside 22 tons of newly acquired gold. Purchased asterisk at the same time the official real yield spiked to 2.4%. They didn't hedge. They didn't diversify. They overwrote. That's not portfolio management. That's firmware replacement. Because when the institutions that issue, hold, and settle U.S. debt stop believing the yield, the entire risk-free rate architecture collapses silently, without error messages. Think about what that actually breaks. A 30-year mortgage isn't just a loan. It's a 30-year bet on the stability of the real yield curve. If that curve no longer prices sovereign risk but instead measures only Fed exhaustion, then your monthly payment is priced on a phantom. Same for pension funds. They use TIPS yields to calculate liabilities, how much they'll owe retirees decades from now. That math assumes the yield reflects actual solvency. But central banks just proved it doesn't. They bought gold because the yield stopped meaning what it used to mean. So what does your pension fund's liability model actually price? Not risk, not inflation, not time. It prices faith in a number that's been quietly retired. And that faith isn't abstract. It's $4.20 trillion in U.S. corporate bond spreads, all anchored to that same broken yield. It's $28 trillion in global equity valuations, all discounted off the same deprecated signal. This isn't theoretical. Bloomberg confirmed central banks doubled gold purchases while asterisk tips yields climbed from 1.1% to 2.4% over 2 years. They didn't wait for a crash. They didn't wait for crisis. They upgraded before the system failed. Because they knew. Once the primary risk gauge loses credibility, every derivative model built on it inherits that flaw. Like running Windows 95 on a quantum chip. The interface still works. The icons still load. But the underlying logic? It's not just outdated. It's asterisk incompatible. So ask yourself. Who signed off on pricing trillions of dollars of debt and retirement security using firmware that's been revoked by its own architects? What model still assumes the yield means what it used to mean? That's not a glitch. That's the sound of the foundation cracking and no one hitting pause. You're not watching gold rise against bonds. You're watching the last universal language of sovereign risk go silent. And the scariest part? No one turned off the feed.